You open a trading chart and your screen is cluttered with a dozen different colored lines, oscillators, and histograms. The RSI is flashing overbought. The MACD is giving a buy signal. And another indicator you don't even recognize is suggesting a sell. This is what we call indicator overload, and it's the fastest way to become a paralyzed and profitable trader. The truth is, most indicators are just derivatives of price and volume. They're different lenses to view the same information. Your goal isn't to collect the most lenses, but to find one or two that work for your eyes and learn how to use them with expert precision. In this video, we're going to master the two most popular and powerful momentum indicators, the RSI and the MACD. We'll break down exactly what they're calculating, how to interpret their signals correctly, and most importantly, how to use them together to filter out noise and execute high-probability trades. Let's start with the king of momentum oscillators, the Relative Strength Index, or RSI. Developed by J. Wells Wilder, the RSI measures the speed and magnitude of recent price changes to evaluate overbought or oversold conditions. It's displayed as an oscillator that moves between 0 and 100. The conventional wisdom says that an RSI reading above 70 indicates an overbought condition, potentially signaling an impending pullback, while a reading below 30 indicates an oversold condition, suggesting a bounce might be near. But here is the critical mistake most beginners make. They see an RSI go above 70 and immediately short the stock, or see it drop below 30 and instantly buy. This is a terrible strategy. In a strong, trending market, a stock can remain overbought or oversold for a very long time. An RSI reading of 80 doesn't mean sell now. It means momentum is extremely strong to the upside. The most powerful way to use the RSI is not by looking at the absolute levels, but by looking for divergences. A bearish divergence occurs when the price makes a new high, but the RSI makes a lower high. This indicates that while price is still climbing, the underlying momentum is waning. And a reversal is likely. The opposite, a bullish divergence, occurs at market bottoms and is one of the strongest buy signals in technical analysis. Now, let's demystify the MACD, which stands for Moving Average Convergence Divergence. While it looks complex, its components are simple. The MACD consists of three parts: the MACD line, which is the difference between a 12-period and 26-period exponential moving average, the signal line, which is a 9-period EMA of the MACD line, and the histogram, which visually represents the difference between the MACD line and its signal line. The most basic signals are crossovers. When the MACD line crosses above the signal line, it generates a bullish buy signal. When it crosses below, it's a bearish sell signal. These are helpful but, like all crossovers, can be lagging and produce whipsaws in a choppy market. The more advanced and powerful way to use them is, once again, divergence. The same principle applies if the price is making a series of higher highs, but the MACD line is making a series of lower highs. It's a bearish divergence warning of weakening momentum. The MACD histogram is particularly useful for spotting these momentum shifts early. If the histogram bars are getting shorter while the price is still rising, it shows that the momentum driving the move is decelerating fast. So you have RSI and MACD. Both are momentum indicators, so why use both? Because they complement each other beautifully and help you avoid false signals. The RSI is a bounded oscillator, perfect for identifying potential reversal zones in a ranging market. The MACD is an unbounded oscillator that is exceptional for trend identification and measuring momentum shifts. Here's a practical way to combine them. First, use the RSI to identify a potential opportunity. For example, the RSI drops into oversold territory below 30 during a pullback within a longer-term uptrend. This doesn't mean you buy yet. It just puts the stock on your radar. Then, you wait for the MACD to confirm a shift in momentum back to the upside. You wait for the MACD line to cross above its signal line, preferably with the histogram turning positive. This two-step process, RSI for the setup, MACD for the trigger, forces you to wait for confirmation and dramatically increases the reliability of your entry. Of course, the trading world has other popular indicators, And it's worth knowing how they fit in. The stochastic oscillator is very similar to the RSI, also measuring overbought and oversold levels between 0 and 100. But it does so using a different formula based on the closing price relative to the recent high-low range. Bollinger Bands are a volatility indicator that create a dynamic envelope around the price. A squeeze in the bands often precedes a significant volatility expansion or a big price move, but the golden rule remains: do not stack indicators that tell you the same thing. Using RSI, stochastic, and Williams percent R together is pointless. They're all momentum oscillators and will give you redundant, often conflicting, signals. The professional approach is to choose one or two indicators from different categories, perhaps one momentum oscillator like the RSI, one trend following tool like the MACD or moving averages. And then always use volume for confirmation. This creates a multi-layered, robust trading system. Remember, indicators are not crystal balls, they are probability tools. Their greatest value is in helping you define your risk and manage your trades. This content is for educational purposes only and is not financial advice. Trading is risky, and you should only risk capital you can afford to lose. If this clear breakdown has helped you finally understand how to wield these powerful tools, please support the channel by liking and subscribing. Now I'm curious, what's your favorite indicator combination, and why does it work for you? Share your approach in the comments below.